AIFs are getting bigger and better. And to take us through the opportunities in AIF, we've put together a panel of seasoned experts. So let me kick off the session by inviting on stage the moderator of this panel, Umang Papneja, the President and Chief Investment Officer at IIFL Wealth. Joining him is Akshay Gupta, who is the Group Executive Head and CEO of Asset Management at India Bulls. Up next, please welcome Ajay Mansukhani, who is a partner of Malabar Investments LLC, which is a dual focus on investment analysis and risk management. He's received his BSc and MBA from the Wharton School. Can we please put our hands together and welcome him on stage? That's Akshay Mansukhani. And finally, we have Sanjay Nath, who is the co-founder and managing partner of Bloom Venture Advisors. He's among the best-known VCs in the country. So with that, it's over to you, Umang.
Thank you. Hope everybody can hear me at the back. Okay. So I've got a very illustrious panel. So what we're going to discuss over the next half an hour or so is talking about alternative investment funds. So we have a very mix in the sense of categories. So everybody knows that there are category 1, category 2, and category 3. So what I've tried and done is our panelists represent each category. So let's do it that way. And of course, I think we were supposed to have one more panelist who would represent the hedge fund industry. So if he comes, it would be very good. So that's extreme left is Sanjay Nath. Sanjay Nath is the founder of Bloom Ventures. It's one of the most illustrious venture capital firms in the country. So here I want him to concentrate on category 1 and maybe a little bit of category 2. You got Akshay Mansukhani, who's a partner at Malabar Investments. Of course, Malabar does very very marquee long-only investments in the small cap space. But what is important to know today from Akshay is what he's done on the Narayan Murthy committee for AIF. So he heads category 3 for the Narayan Murthy committee. And of course, I've got then Akshay Gupta finally from India Bulls. So he's done a lot of roles. He's looked at the mutual fund industry, which most of us are aware of. But he's also slowly and steadily coming into leadership position as far as AIFs are concerned, starting with his real estate fund. So that's we can take his views on category 2. So I'll start with all of you. It's a general question. So probably Sanjay can pitch in first. I just want all three of you to do some bit of crystal ball gazing. When I say crystal ball gazing is where do we see this AIF industry or AIF AUMs by 2020. So just crystal ball gazing on the size. Today, just for your reference, we are closer to 40,000 crores in the last 3 years since the regulation has come. So regulations came out in 2012. So we've been 3 years in this era. And we've raised or committed, there are commitments of 40,000 crores. Which is lesser than the PMS industry and much lesser than the mutual fund industry. So just your thoughts, Sanjay, first.
Sure. Good afternoon, everyone. Thanks, Umang, for the opportunity. I'll begin by saying that, traditionally, venture capital has almost always raised internationally, right? I think it's a very welcome change. Only the last 5 years where many funds like Bloom and K have also been aggressively looking at within India. So I think that's notable. If you look at even today, if you look at the traditional VCs, Accel, Sequoia, Nexus, they're still 100% overseas LP dominated. So I think that is very different from PE and public markets, which is interesting. I think if I had to you asked about crystal gazing. You look at the IAF fund, right? The India Aspiration Fund, of which we are one of the recipients. I think that whole allocation is something like 5,000 crores, which may get to 10,000 crores. Which is, thanks to the Modi government, wasn't even on the radar screen earlier. So the opportunity is massive, and it's a very welcome opportunity. I think having said that, we have not seen huge changes. Earlier, the first fund was operating under the VCF category. Now we have AIF Cat 1, which will continue. We can get into, sort of wish list things later. What I'd sort of like to kick off the discussion with is, I think one of the areas that we would love to see, more movement is just more parity on as far as taxes are concerned between unlisted and listed securities. But having said that, I think nobody in the VC space, whether it is an incubator, accelerator, or Series A VC, is ignoring domestic capital. There is a lot of appetite for it, and besides the tax parity, I think most of the changes are quite welcome.
Great. So I just want to add one bit on what Sanjay mentioned. So um, all of us remember the Startup India, Stand Up India, the word which was coined by our Prime Minister. So of course that was followed on by a fund called the India Aspiration Fund, which SIDBI runs. Now what we've seen is, of course, a lot of venture capital funds mushrooming and getting allocations from the government, which I think is a great step in the right direction. So Sanjay is also one of the recipients of money received from the India Aspiration Fund. Akshay, yeah.
I'll just cover a couple of the highlights in terms of the asset base, and then answer the question in terms of crystal gazing. So 14 lakh crores on the mutual fund side, roughly 67,000 crores on the PMS side, and today in category 3 we have roughly 3,700 crores of asset base. In terms of where this piece, specifically category 3, goes by 2020, I presented to Mr. Murthy in the panel on Friday saying 100,000 crores. And I backed that up by saying that, look, you have to look at a host of different metrics in trying to get to this number. And the bottom line is, where are the earnings of corporate India, the largest 50, 100, 200 companies growing? And when you study them sector by sector, you understand that this nominal rate of growth of that India is experiencing, 12, 13, 14%, is actually translating into earnings growth for many of these businesses. And so seeing 15 to 20% sectoral growth, certain sectors, results in a fair amount of money chasing these companies, because from a long-term perspective, keeping valuations the same, one should see a fair amount of appreciation of value, just because these companies are going to be growing in that manner. And then second point is just looking at the depth of the markets itself and what types of securities that can be invested into. Today, Cat 3 covers long, short, commodity, futures, fund of funds. And look at it globally, long short is, I think, the $300 billion in long short across the world. And there's no reason why, as today we have 200 companies where you have F&O activity, liquid F&O activity, tomorrow it may go to 500, 600. The depth of those markets also grows. And so I think in no uncertain terms, the market is there. And then the last point is just on the AIF structure. SEBI forces, say, a fund manager to put in some skin in the game and some investment of their own. There are certain things like this which actually promote the growth of the industry, because there's an alignment of incentive between the fund manager and the investor in terms of actually generating returns. So I think the stage is set pretty well. As long as we can get to certain tax clarities and classification clarities, we'll touch upon in a few minutes. I think we're good. We're set to go.
Akshay, your take.
Hello. I think a few things on the macro side. Today, if we talk about the MF assets under management, we're talking about 14 lakh crores, which have been growing significantly in the last 10, 15 years. But the rate of growth is about 10 to 15% per annum. And that also depends largely on how the markets behave. But if you were to just compare apples with apples, the retail base is about 5.5 lakh crores. So if you exclude the money market or the taxation-oriented funds or FMPs, you're looking at 5.5 lakh crores, which has been developed over the last 25, 30 years. PMS is a product category which has its basic logistical issues, because now it is not unitized. The pool has to be broken individually into each investor. So PMS has stagnated as a product category. AIFs, which were the earlier private equity stroke VC, is the new sort of kid on the block. And the reason is simple. Both on the asset side and the liability side, which basically means deployment side and fundraising side, SEBI assumes, the regulator assumes that there is far more involvement of the customer, and the customer is an evolved customer. The advisors give more time for closing that business, and therefore, certain risks, more than the mutual fund risks, can be taken. So that's the basic premise. Hence, you would not find things like in mutual funds, if you were to just take, there are various restrictions, expense ratio restrictions, commission restrictions, deployment restrictions in terms of sectoral restrictions for debt and equity, per security or per instrument restrictions. Then within sectors, there's a restriction of NBFCs and HFCs. So there are lots of restrictions that have been placed for the MFs to continue their business in a very ethical manner, so that there is no erosion of confidence if there is any goof up that happens, like what happened several years back in the UTI case, if you guys remember. The regulator assumes that in the alternate fund space, the evolvement of the customer and the involvement of the customer is so high that he is a very informed customer, and therefore the restrictions aren't that many. And therefore, if you were to just compare 40,000 crore, which has just happened in the last 3-4 years, domestic commitments, vis-a-vis a 5.5 lakh crores of the mutual fund AUM, and vis-a-vis about 70-odd thousand crores of PMS, it's the fastest growing. And my sense is in the next 5 years, this 40,000 crores will be 2 lakh crores. Compare that with mutual fund retail stroke HNI AUM, which is 5.5 lakh crore, that will probably touch 7.5-8 lakh crores. So there is a clear movement of domestic money in the HNI space from mutual funds to more structured instruments like AIFs. And why I say structured is because the lesser number of restrictions, the more customization, and better fee sharing and understanding aspect. So that's why it is more customized than the standard mutual fund category. So in terms of growth rate, if you were to ask us to do a future tell, perhaps this will be far bigger in terms of growth rate as a product category. But in terms of absolute size, because the base of mutual fund customers is the whole nation which can invest, it will perhaps never reach that. But clearly, the growth rates are more in the AIF segment vis-a-vis both mutual funds and PMS.
Good, thank you, Akshay. I think it's a fantastic crystal ball gazing we have done. I think numbers from 1 lakh to 2 lakh crores coming out from all three of you. Just one thought on, I was just hearing you speak, and you spoke about the informed investor. So there's been a lot of debate on this one, saying that is 1 crore the right amount, or should we say that, if so-and-so person has more than 10 crores net worth or 20 crores net worth, he should be allowed to invest any amount he wants. He can invest 25 lakhs or 50 lakhs. So just the fact that you should be an expert investor. So what's your take on that one, Akshay?
So, determining net worth and determining investable surplus, and you've been longer than me in this business of handling HNIs. But it becomes a very tough benchmark to determine. And with disclosure norms in India of basis income tax being very, very questionable, I think ticket size of a particular investment perhaps is a more uniform and easy way of determining what an involved customer is. So mostly people assume that if a guy is putting 1 crore in a particular scheme of an alternate fund, he would have at least 10 times of that. So a 10 crore customer, investable surplus customer, would have fairly good advice coming to him from a variety of advisors, formal and informal advisors. And I think, therefore, 1 crore ticket size to start off with for the next 3, 4, 5 years, till that 1 crore also becomes small, is reasonable to me.
Correct. And of course, most of the funds are drawdown in nature, so it's just commitments. So obviously, yeah, Akshay.
Just add very quickly to that, as part of our Mr. Murthy's panel, the concept of accredited investor is something that we spent an hour on Friday discussing, specifically understanding the challenges which were just pointed out, saying that, look, and SEBI's argument was the same, that, well, if there's a certain amount of investment, a crore happening, clearly there's a level at which we do not need to be concerned. And it all stems from, the blue sky laws of America, where you cannot really cut pieces of the blue sky and sell it to your mom and pop. And how do you differentiate between your mom and pop and, and the next person? And so I think from an accredited investor perspective, where the challenges, both RBI and Ministry of Corporate Affairs and other groups, is that who's going to certify that you have a certain net worth? Is it going to be your CA? Because that could be potentially manipulated. And so these discussions are yet underway, and they have massive ramifications for crowdfunding and other types of platforms that SEBI is issuing new regulations on, because then these types of investors, will have lesser compliance.
Yes.
Yeah, Umang, I just want to add quickly to those great points. Like Akshay was saying, if you look at the US and Silicon Valley, they have this the concept of that accredited investor, right? Which you've got to have at least a net worth of 1 million or 1 million of investable assets, and you've got to be willing to hold that. So, for example, in our first fund of 100 crores, there was one wealth manager who suggested, hey, it'll be much easier for you to raise the fund if you bring down your ticket size to 25 lakhs. And at that time, we were under the VCF, so you legally could. So, barring the exceptions where we actually took smaller, less than 1 crore from internet founders who really added value to a lot of the Bloom portfolio companies, in the other, our learning was that those were not the right type of investors, even for themselves, because they couldn't hold on, and their return expectations were in like 1 or 2 years, whereas this is a long-term asset. Just weaving the other point, I think, coming back to the crystal gazing, I think if you look at the surge in number of AIF applications, look at the number of institutional family offices that have set up, right? Look at the Jindals and look at the others. Very interestingly, and I'll weave this in later, but our space is actually, the earlier you go, it's very collaborative. It's less competitive because you want to diversify your risk and you want to leave more for your follow-ons. So in many cases, some of those family offices are becoming LPs in funds, but are also co-investing. And in that sense that, the market is big enough for everybody. So lots of, I think the AFs are also getting set up thanks to these new institutions being created from family offices.
So I want you to stay with that thought actually. So what you've started is talking about trends which you've kind of seen in local markets, but what I think the audience also would want to know from all three of you is trends while raising money in domestic, and also what do you see as a difference when you go to overseas markets and raise money? So both, Akshay and Sanjay have been raising money from offshore quite a lot. So maybe your experiences starting from Sanjay?
I'll say fundraising is a lot of fun. Obviously not, that was a joke. I think what is, our own learning is that I think long-term fundraising has to become institutional, right? I think when you start off, you start by, our learning was you start by going to the people you know within your network, but ultimately I think you have to partner with institutions, that's one. I think what is very interesting is, Akshay Gupta also made the comment that the investors becoming more informed. And I think that is very true. Today you have fund-of-fund investors, like you look at CPBIB and others, who are setting up office in India itself. And they're saying, and sometimes they may question a Singapore-based or US fund manager saying that, I have an office in India itself, and I'm getting access to these direct deals. Show me the value that you're adding. I'm seeing a lot of these deals myself, and my job is a fund of funds. So I think there is a lot of onus, and therefore the differentiation for a lot of us to curate better deals, to add value to them, to actually add value to them even before we make an investment decision. I think one interesting thing is, when we were starting on the first fund, there were a lot of, and we didn't have a brand, investors would come to us and say, we have such a great brand, we want to invest in the fund, just allow us to co-invest. And at that time, it was a little difficult to say no. Today, we can do that. But what is working well is, just let's look at a corpus of about 500 crores. I think what is working sometimes is that, if there's an investor that's going to give you 50 crores, we'll actually go to them and say, give us 30 crores into the fund, and then the 20 crores keep on your books, and we'll take different economics on that. And I think that's very win-win because it's not 0-1, it's not black or white, and they want to co-invest with you because they are more aligned with your interests. So I think that dual combination is working well.
Probably what I'm reading from that is, so probably put half in the fund, maybe roughly, and keep half for co-investment. So that's a trend which you're seeing more Indian families do, or worldwide?
I think, I'll say this in the room, definitely I think Indian families are very particular about fees. If you're overseas, I think there's definitely less pushback as far as that is concerned. Also because here you see many of those deals yourself, right? So you may see that. But I think what is interesting, as the fund sizes become larger, I think for a 60 million, 360 crore fund size, it matters less. But I was talking to the head of a large VC who's raised a fund in excess of 500 million. And he was actually saying that they might think of cutting back their, the actual target fund size and leaving the rest on the investors' books. Just because the larger you go, it's more difficult to return in terms of absolute rupees or dollars. So I think we are seeing, more disciplined fundraisers if that's possible.
Yeah, and one more point about, you said about the Jindal family office example which you gave in. So, just to recap, AIFs do not have that 20-25 rule. So you could potentially have only the sponsor and one investor. So Sanjay, are you seeing that these larger families are setting up their own AIFs so that they can do investments on their own? Is that a trend?
Yeah, I think it is. I mean, you look at Mr. Mohandas Pai also, right? I mean, I think he's a wonderful individual. He was part of that IAF which allocated some corpus to us. I'm sure Akshay also works closely with him. They've got so many different offices. They're aligned with funds. They're also making direct investments, and they're also looking at multi-pronged strategies, right? Part of on the angel side, they may actually make 20 to 30 investments more sort of spray and pray. On the other side, they might do more control in a certain sector. So I think it's very healthy for local entrepreneurs to get local money because they get the local support. There's exited every time. I mean, every time there's an exit, there's more money that goes back into the system. Mr. Ronnie Screwwala did that a couple of years ago, and I think it's great to have that local support for Indian entrepreneurs.
Great, fantastic, Sanjay. So thanks for the trends. Moving on to Akshay, maybe on the long-only space.
Sure. Just quickly, add to the last statement. There's when you think about the size of the asset management industry, and if you have some very smart people that Sanjay just mentioned, generating good returns, to the extent you can show a clear track record, you may be able to raise a fair amount of money on the heels of that. So I think that may be some of the thinking, because when you actually go into an AIF, your leverage limits, there's a bunch of things that actually get constrained, where you do not have those constraints in your individual capacity. So there's a trade-off there. I wrote down 3 trends on the global side in terms of what I'm seeing, and I think one of them was touched upon. The first thing is we manage capital investing in Indian small and mid-cap equities, and one of the trends that we're noticing is that large allocators globally are looking for country-specific funds. Earlier, been in business now close to 8 years, many of the larger institutions would say, see, I have an Asia allocation. I have a manager sitting in either Singapore or Hong Kong. 10, 15, 30% of his portfolio, depending on his decision, is allocated to India. And so we're fairly comfortable that we don't need to go out and actually look for somebody like you who does only India investing. And I think that's changed as the world and institutional investors have realized that the risk profile of different countries is vastly different. The currency risk profile is vastly different as well. So when you tack on both of those, it makes sense to look at country-specific funds. The challenge with the country-specific funds is that you cannot allocate too much capital to such type of strategies. And Sanjay mentioned that there are certain larger sovereign wealth funds, Norwegian wealth fund, their ticket is $1 billion per manager. That's their ticket. So how can you invest $1 billion into small and mid-cap Indian equities? In our mind, for the work we do, we're capped out at 400 million. So I think there are challenges with that. Second is the focus on the Fed and where the rates are moving and correlations. You hear this time and again across the globe as to what are the correlations, Akshay, for your strategy with what we are doing. well, we're invested in completely different securities. Mayur Unicota's leather sales are going up 40, 50% on an annual basis. That's what's driving the value of my, of my portfolio. What is the connection with, what you're looking at? And, but this conversation keeps coming up. And what happens is over long periods of time, correlation breaks down with a country like India, but over shorter periods of time, the correlation exists. So that the people are waking up to realize that this long-term correlation breakdown actually is true given what's happened in the last few years. And then the last trend I would mention is quant trading and quant focus. You see the amount of capital that's going into quant funds globally, and it's very, again, the challenges for India is that the markets are not deep enough. So when you talk to a D. Shaw doing billions of quant trading, the first question I ask is, well, how much do you think you can manage in India doing quant trading? He said, well, between 100 and 200 million dollars. And so clearly it's not exciting for them to be setting up shop in India to be doing just 100, 200 million of quant work if they're not going to see the scalability of that. And I think that's something will take a while to change, on the Indian side.
Great, thank you. So, Akshay, I'll come back to that quant bit in a while, but let's take Akshay's view on the trends.
As far as fundraising is concerned, I think the challenge is clearly to educate people. The moment you say AIF, people get a little scared. They think it's, some a Martian kind of word, which people think that it's like, Mr. Mansukhani was saying, quant trading or leverage, etc. So they get kind of scared as to what this extraterrestrial animal is. It's a very simple thing. AIF is exactly like a fund, a mutual fund. It has to have a theme. It has to have an asset class. Except that, what I said earlier, the same thing I'll reiterate, that it has less of restrictions. One of which Umang pointed out that you don't have to have, 25%, maximum 25% per investor, minimum 20 investors. Like some of you would have faced challenges in some of the FMPs that came in the market. Even on the asset side, which basically means deployment side, if you want to do a pharma fund, you can do a pharma fund. If you want to do a real estate fund, you can do a real estate fund. You don't have a 30% sectoral cap, which SEBI puts on certain funds. If you want to do a real estate plus infrastructure, you can do that. It can be debt and it can be equity. So it's exactly like a mutual fund with less restrictions, with the assumption that the investors are fairly evolved to understand that why these restrictions should not apply and what are the standard disclosure norms. Let me assure all of you in this room, SEBI is the regulator, and SEBI in particular is as worried and as cautious about alternate fund disclosures and norms as it is about mutual funds. So there is no let up in terms of audit or in terms of disclosure norms. It's just that the restrictions are lesser. So for example, if there's a credit fund in a mutual fund setup, right, you will have various types of credit. Like there'll be a mining company, there'll be an electricity company, there'll be a MFI, microfinance company. Now a person like me who spent 20 years in corporate banking and capital markets, I believe that the securities behind these companies, whether it's a power sector company or a mining company or an MFI, the security behind or the collateral behind these bonds, the debentures, the NCDs, is quite suspect, because what will I do with the pari passu charge of a mining company of a mine in Chhattisgarh? Even if I were to auction it, there'll be like 10,000 restrictions to auction it. So I would prefer to have a real asset in front of me, a physical asset, maybe a half-baked building or a piece of land or a private jet of a businessman, which can be easily liquidated, right? So therefore, thematic funds can be built around what you feel you are most comfortable in, where your expertise lies. The other big thing which one of my co-panelists said was the tenure of fundraise. I think that's become very critical. With changing dynamics both in the equity side, listed or unlisted, and in the fixed income side, with interest rates going up and down all the time, You can't keep raising money because, what you have promised to your LPs or investors who invest in your fund needs to be delivered somehow. So you can't have a 2-3 year fundraise. Typically, a lot of these overseas funds, they continue for 2 to 3 years. And of course, those fund tenures are also very, very long. But in the domestic market, we have seen that fundraise has to be crisp, short, simple, and it has to be deployed fairly fast. And that's when you get those repeat investors. So our learnings from one of the first funds that we did last year, and very quickly we raised a lot of money, was you have to be quick, you have to involve all types of customers. So we had 10 family offices, we had 1 crore HNIs, about 200 of them giving us money. We had institutions, banks, etc. To cut the long story short, you need to approach everybody, every type of customer. And you need to be quick because you don't know when the market dynamics will change. In India, long tenured funds are not preferred. So people are very happy in the sweet spot of 3 to 4 or 5 years. If you go to any investor, whether it's a family office or an institution, and you tell him, and I'm talking about Indian family offices and institutions, and you tell him this is a 10-year fund, chances are you won't even get a repeat meeting. So Indian investors for alternate funds are in the evolution stage. They are tasting, they are sampling. This is the trailer, but the real story is yet to begin.
Thanks, Akshay. I think you've given us a lot of points to think on. But generally, I mean, of course, you don't have to speak for them, but why is it that none of the top 4 AMCs are in the AIF space?
That's a very good question. Look, I mean, if you are already, have a roaring business in the standard mutual fund space, to try and get a small chunk of the pie of the 38,000 crores is not very exciting for you. I was in the topmost mutual fund for many years when it became the topmost mutual fund. Whenever we used to be shown as a strategy session, we used to be shown one small segment of business growing very fast. And we used to be told, should we be participating in that segment? The answer used to be no. Because the top funds, they look at a segment or a strategy or a product category only if it is very scalable. If it really excites their balance sheet, then is when they actually take the plunge. They are not interested in 8% of 38,000 crores. Let this become 45 lakh crores and you see all of them plunging there.
Sure, good. So we are now running short of time, but what we'll do is the last thing which we'll touch upon is the challenges. So starting with category 1 and 2, Sanjay and Akshay, maybe you can just quickly, and then we go on to the larger issues of category 3 because that's perceived to be a very tax unfriendly structure. So we'll take Akshay Mansukani as the closing remarks. Sanjay.
Sure. And Umang, I'll talk less about category 1 and just more broadly about fundraising. I think that because it's possible that 3-4 years there may be a different category. Yeah. Especially relative to overseas fundraising. I think one of the things, and this is related to Indian psychology also, we've seen that a fast no is the most important. It's sometimes better than a slow yes also. I think we find that as a culture in general, we never say no. And the fund manager wastes a lot of time. All of you will waste a lot of time. So one of the quick things is, we're doing a first close. Are you going to come in? And if not, are you interested in this asset class at all? Sometimes they may just be interested only in co-investment. So I think we say that and we follow the same philosophy even when startups come to us, right? We just tell them no, but you go and talk to 3 other people because this doesn't fit our category. That's one. I think what works is very often the first close becomes very important for funds. I don't know if that applies for mutual funds, but more for private equity and VC funds, where some of the investors, marquee names especially, want to see what you've done with that quantum raise, right? So what really worked well for us is we did a first close of about 5 million, then 30 crores, and then had done about 3 deals, and they were taking off. And you go with a proven basket of securities, and that actually gets received quite well. I think what is very interesting is if you look at the VC space today, while the valuations have come down, which is a very healthy correction, The fact is that there is a lot of money valuable. I mean, there's a lot of money available. Look at Nexus, Sequoia, Axel, they've all raised about 2-3 times of the last fund sizes. That's one. Our fund size also will be about 3 times. And there was an interesting cover article on Fortune magazine saying that if you look at the top 10 unicorns, internet unicorns globally, many of them are choosing to stay private because the minute they, they go public, they have to deal with other kinds of situations. So I think the fact that there is money available is positive. I think the challenge just seems to, for us and the intermediaries out there to actually focus on who's the right type of investor for every asset class. Not all investors are created equally, to understand very quickly what their risk-reward profiles are. And I think a diversified approach is quite healthy. We see family offices who, would like to invest in Akshay's fund, would like exposure in VC also, and that is healthy. So I think what is good about the AIF Cat 1 is that it's made it easier to focus on those 1 crore type investors, right? You know that if a person is ready to invest 1 crore in a early stage VC fund, they have the staying power. They're willing to stay on at least for, the 8+1+1 like Akshay was saying earlier. So that is positive.
Challenges?
I think the challenges are parity in terms of taxation. So, if you would have read in the newspapers recently, EPFs, provident funds and pension funds have been allowed to invest in AIFs, depending on which category they are in. Some of them can invest 5% of the total corpus, some of them can invest 2% of the incremental corpus. And surprisingly, in our second fund that we've launched, we've already got 100 crores from EPFs. Now, they are up in arms saying that you cannot deduct the 10% at source. That TDS cannot be deducted because we are exempt from tax. Now, we've been running helter and skelter to CBDT, to SEBI, to PF Commissioner, et cetera, but we haven't been able to find a solution. So any new thing has a teething trouble issue. These are the challenges that we will face with new customer segments, new strategies, new territories, etc. We will face, like, for example, NRIs could not invest in AIFs. And, you would laugh it out if I tell you why. Because the NRI regulations have not been amended from 2009, and the AIF regulations came in 2012. So, therefore, they have not been included as a customer category to invest in AIFs. Now, this is how our country works, unfortunately, but that's the truth. So, now, finally, NRIs and any foreigners have been allowed to invest in AIFs. Caveat is that it has to be an Indian sponsored and managed alternate fund. Now, how ridiculous can you get? Because ICICI is owned by FIIs, HDFC is owned by FIIs, India Bulls, where I work, is owned by FIIs, 68%, IFL is owned by FIIs, Religare is owned by FIIs. Who's left? So, such regulations come out after plenty of sessions and lobbying, and then it takes another 3 to 4 years to change that and put some logic in the minds of the regulators. So the problem is that I think the teething troubles to me is really one big challenge. Taxation parity with similar asset classes underlying instruments or structures like MFs is another challenge. And thirdly, which is more of a category 3 issue, the challenge is really on whether you can leverage and get into multiple product categories, like commodities, currency, etc. So if we were only to do debt and equity and hybrid, then frankly, AIF will never become or take off the way it should take off. I think a lot of strategies should be allowed within the asset classes. A lot of asset classes should be allowed. And leveraging, which is internationally a standard, some countries it is 7 times, some countries it is 10 times, some countries it is 5 times. There should be a specific regulation on leveraging. So I think that's really the challenges.
Good. So one thing, of course, Akshay mentioned, but I'll also in the same breath say that the regulator has been very, very open to suggestions. So I think things are moving in the right direction, and Akshay has, of course, been on one committee. So Akshay, we've already ran out of time. So maybe quickly you want to just tell us the challenges.
Thank you. So I chair the subcommittee on leverage, and as of Friday, Mr. Murthy and SEBI threw a bunch of different issues under my committee as well. I'll just identify the issues on the leverage part, the classification, and the taxation, and it'll be fairly quick. On the leverage part, I think there's a great deal of confusion because the AIF regulations that came out, when they define a hedge, it's very simple, 101, it refers to a mutual fund circular in 2002, and that circular doesn't provide as much clarity. And so simple, if you bought Nifty and you've shorted a future on the Nifty, your Finance 101 should tell you that your exposure is basically 0, but for our regulatory purposes, your exposure is 1. And so as of Friday, there was a big push to clarify these issues, and the regulator has said yes, we're willing to work towards. And I think the essence of it, which has been touched on today, is that if there's a different underlying, should the regulator treat those different underlying securities in a different manner when it comes to leverage. I think once this is clarified, only then can we increase the leverage limits from 2x to whatever the new leverage limits will go to. On the classification, I think the basic problem is, what is your residual category? You have 1 and you have 2 and you've got pass-through for 1 and 2, but on Cat 3, are you going to include all long-only funds, long-short funds, commodity funds, fund of funds, all of these different kinds of funds in one category? Is that the right thing to do? And that's really the question that we're posing, because indirectly this classification has massive ramifications on your taxation. And then that's the last part, which is the taxation. And on the taxation side, there's a lot of suggestions that are being made. Look, can we make AIF taxation similar to mutual funds, similar to FPIs, similar to Cat 3 should be similar to Cat 1 and 2, where you're getting passed through. If we don't get any of these, let's just clarify the recent circular that came out. And I put my hand up and say, well, the points that Akshay made earlier with regards to how does this category become a 100,000 crore category is the way we should be approaching this whole thing. And there needs to be not just clarity on a specific circular, but amendments in the tax code to go forward. And there's a host of suggestions we've made, but in essence, the starting point is to understand from CBDT. We met with Mr. Jaitley and Mr. Jayant Sinha recently to ask these questions, and they've informed us that CBDT is going to take us very seriously on the suggestions we make. But just to give you an example, does long only, if you were to do no hedging, would you as a regulator and a tax authority feel comfortable providing tax pass-through? And the answer was warm, saying that yes, if you were to carve this out, we may consider pass-through for long-only funds. But that's something that we need to get to for the next budget, and the plan is to get our work done before we hit into November. So.
Good. So I think thanks all of you for participating and enlightening us and the crowd. Maybe, I don't know if there's time for Q&A, Prem, or we can conclude. Oh, that's it. Okay. Thank you very much for your patient hearing. Thanks.